Good afternoon, good morning, good evening, wherever you are streaming from. There we go. And we are now live on Instagram as well. So, what I'm going to do first is let's switch our view here. Okay. And here we are. So, we're going to go ahead and give people a second to get in the room. We have some really good information for you today. We have a guest expert, and I call him an expert because he's an amazing person, and I can't wait for you guys to get some valuable information from him. He is my go-to person when it comes to financing and mortgages for all of my clients, and so we'll give everyone a few minutes to get in. I am going to see if I can pin the link to join the class or get to check out the rest of the trainings that we have. So let me go ahead and do that. Boom. There we are. So we're going to go ahead and get started. I know it is lunchtime for many of you. And so the purpose of this training is to give you guys a quick lunch and learn. We have a lot of valuable information. And so I want to go ahead and get started so that Jeff can take over and just go ahead and dive in. And so I want to, and if you guys see me looking over here, I have multiple screens, so bear with me. I'm not the best with technology, but I am learning. So here we are. All right. So I want to welcome everyone back. Today is our latest episode of the Realty with Roy Summer Home Ownership and Financial Literacy series. Today, our class that we'll be training on is Home Financing 101. Put a 1 in the chat if you put a 1 in the chat if you can see us. You can see both of us on the screen. Everything looks good on your side. Please do that. But before we get into it, I want to tell you guys a little bit about me. My name is Royce Williams. For some of you who are new, I have been a licensed Florida realtor for 14 years now. I had my 14-year anniversary this past June. I specialize in working with first-time home buyers, military personnel, and investors. I am also the author of a top-selling homebuyer planner entitled Next Stop Home Ownership. And so I absolutely love real estate and I love educating. I'm a huge advocate for building generational wealth through real estate. And so these are a lot of the things that I like to put on for different people. So this educational course stems from that, where we're teaching everything about home ownership and financial literacy. And so today you guys are in for a treat. We have a special guest expert who will essentially uncover some of his strategies for helping buyers lower their monthly mortgages and, basically talking about all the loan programs that are available to you. And so without further ado, before I introduce our expert, I just wanted to let everyone know who's on here. Feel free to raise your hand, put your questions in the chat. We do have a Q&A session, but if time allows, Jeff may take some time to answer your question in the moment. Also, if you are feeling, we do have more upcoming classes. Our next class is Homeowners Insurance 101, and that will be held on Wednesday, the 9th at 12 p.m. Eastern Standard Time. So with that said, I am excited to introduce today's guest expert for Home Financing 101. Someone who's not just knowledgeable, but truly dedicated to helping people get into homes the right way. Jeff McCarthy is a certified mortgage advisor with NEXA Mortgage and has been in the mortgage industry since 2002. He started on the operations side, so he knows exactly what goes on behind the scenes, and that makes him incredibly skilled at navigating even the trickiest financing situations. Over the years, Jeff has personally helped me save as a lot of my client deals, even the ones, because we talked about buying new construction last year, and last week actually, and we talked about how builders kind of structure those deals and working with an outside lender. But Jeff has saved plenty of my deals with new construction, and a lot of them didn't look like they were going to happen. He's especially great with buyers who don't qualify or quite qualify yet. Instead of turning them away, he shows them exactly what you need to do down to the dollar amount to get approved. That level of care, detail, and guidance is why I always say Jeff is more than just a lender. He's part of the team. And honestly, he's part of my family. You're in great hands today. Let's welcome Jeff as he walks us through the ins and outs of home financing and what it really takes to get mortgage ready in today's market.
Yes.
All right, Jeff.
Thank you, Royce. Can you hear me?
Yes.
Good? All right. So yes, thank you so much. Can you see my slides?
Not yet. I'm going to put your slides on.
So I wanted to thank you, Royce. I appreciate it. I've been working with Royce for a long time. And so I love doing these things to kind of help educate and really give strategy because this market, as we'll see with the first slide, is kind of, there's a lot of clickbait going on right now. And if you go to YouTube and search first-time home buyer, you can definitely see everything you're noticing going home in the market. Things are bad. 39, worst market in 39 years. It's so bad to buy a home. I mean, you're watching all of this stuff. Mm-hmm. And the first thing you start thinking about is, why am I even thinking about buying a home right now? Because everything else out here is trying to scare the heck out of you and really, really just, create some media frenzy that is just, it's not as bad as it looks, even though your first thing is the housing market looks bad. It's really not as bad as it looks. But before we get into like, how do we kind of navigate this market, I wanted just to, let's look at some basics here, because that's the most important thing is just no one knows what a mortgage is or no one knows how the mortgage works. Let's kind of go into that. And then at the end, we'll show you strategies that I've worked with Royce on and I've rolled out with her clients and almost every single one of my clients as well to get you set up for home ownership successfully. That's the most important thing. You buying a home's easy somewhat, but it's then setting you up successfully for the future that is really, really important. And that comes with education. So let's first look at what we're going to just look at right here. It's how mortgages work. We're just going to go into the behind the scenes mechanics of mortgages. Mortgage types. Obviously, there's different programs out there and who qualifies and what those qualifications are. And then we're going to look at improving credit and credit score. So we're going to dive into that a little bit. If anybody needs help, improving credit is almost a one-on-one type thing, but we're just going to go over a generalized how does credit work, and if we have some, blemishes on our credit report, how do we fix that? And then best rates. How we're going to find the best rates? How we're going to set you guys up for success from now. Also increase affordability and increase your purchasing power. Because right now, as rates go up, the amount of home you can buy goes down. And so how do we navigate that? Because people want nice homes, but with higher rates, that becomes a little bit of a harder situation to navigate. So first, we'll look at a real basic view on how mortgages work. This is real high level. Then we'll kind of get a little more granular as we go along here. So basically, a mortgage is a loan. So the lender, there's many, when we think of a lender too, we don't really think about banks like Chase, Wells Fargo, Citi. Those are not really mortgage lenders. Those are what we call depositories. You put your money in, they use your money to create more money and then also create a safe haven for your money and, maybe some CDs or money market accounts. A mortgage lender specifically and only does mortgages. So when we think about mortgage as a loan, we don't really associate that with a bank. Mortgage lenders and brokers like myself have a much better, obviously, idea of how mortgages work. We're way more communicative. We don't work bankers' hours, and we usually have better rates than a bank. So that's one of the things, just to kind of briefly, go over a little bit. But when a lender gives you a loan, just like anything, when you're buying a car and they're giving you the loan, they have the car as the collateral. So if you're not making your payments, they're going to repo the car. It's the same thing with your home. The lender's giving you a loan. They're going to ask for the collateral, which is your home. And if you don't make the mortgage payments, they'll foreclose on you. We saw a lot of that during the Great Recession. And then usually the term on a mortgage is between 15 and 30 years. It can change. It could be 10. There's some things now going on where we might start seeing a 40-year mortgage kind of hit the table a little bit to create affordability since rates are a little bit higher and home prices are a little bit higher. When we're living in Florida or anywhere, we've noticed home prices really accelerated during the pandemic, and then they're accelerated really fast, but they're climbing down the ladder very, very slowly, even though rates are higher. So the longer the term, the less the payment. It's just you're in it for a little bit longer. And when we do all this, the most important thing as a homeowner is to build equity. That's the number one reason that we own a home. Obviously, it's for shelter. It's going to be our home. We're going to build memories. But this is also a great channel to build wealth. And that is one of the things that sometimes gets passed by. But it's a great wealth building tool and a great way to access money later on down the road in retirement, or if you wanted to move up or move down, the kids get out of the house, you want a smaller home, great way to sell it. Use the equity that you have to either buy a new home in cash or put a really hefty down payment on there so that we can have a lower mortgage payment. And the equity could also work for paying off bills, redoing the house, renovating the house. There's a lot of stuff we can use equity for. And so that's one of the most important things about mortgages. We're going to be paying a mortgage, but we also are building equity. And that's the most important thing. So before we get into all this, let's look at some mortgage terms. This is stuff we'll be seeing throughout the presentation, but just to kind of go over it a little bit. Principal. So whenever we talk about the principal, it's just how much is left of your balance on your loan, right? So it would be, you'll see it on your mortgage statement. The principal balance is, $300,000. That's how much you have left paying on the loan. We have interest. So that I always look at interest as the cost of getting a loan. So if you had no interest and you bought $350,000 in the house, when you pay that off, you can be paying $350,000. Nobody's making money on that. In America, that's not a good thing. We're very capitalistic, view. So interest is the cost of getting the loan, and the lender makes that profit because they're giving you the home, and they're also taking on risk. Risk is a big thing in mortgages, and we'll look at that when we go to credit score and stuff like that. So interest is always the cost of getting a loan, and interest rates can change depending on credit score, how much you put down as a down payment, what type of program you're using. And so interest is really important because we'll see the difference at the end on price, the price of the home, and then the interest rate and what that does to actually create a payment for you. Escrow. So when we're looking at escrow, when someone says escrow, there's two terms of escrow. When you go under contract, you are considered under escrow, which just means you're in the time that you're under contract and you're buying a home. In the mortgage world, escrow means an account that is set up by the lender that pays for your taxes and insurance when you make the mortgage payment. So when you make the mortgage payment, you're actually paying your taxes and insurance. And then the lender's holding that in an escrow account, and then they'll pay the taxes on insurance on your behalf when they're due. And that escrow account sometimes is mandatory, sometimes it's not. Just depends on the different types of loans you can get. I don't know why we have that doubled. There we go. Appreciation is the building of equity in your home. So we look at appreciation is we're in the home. As more people buy homes in your area, usually prices go up. Now, there's been times where prices go down. In the last 84 years, only 7 years out of 84 has depreciation happened. So we're always looking at appreciation, usually in the real estate market. It just depends on how much. Like right now, we're sitting at about 3.5%. On a normal year, it's between 5 and 7%. Usually. Now, back in 2021, we had 10, 12, 15% appreciation. That's not very normal. It's just really low rates and high demand. But usually demand sets appreciation. So buying a home right now in a little bit higher interest rate is a little bit better because if interest rates drop and the demand increases, appreciation increases, and you're going to be paying a lot more for that same home. Debt to income. This is very important. This is the number one killer of loans. Everyone thinks it's credit score that really kills loans. It's really not. It's debt to income. And it's a ratio the lender uses for the qualifying. I have a couple slides on this because this is very important. So we're going to go into that a little bit more in depth later on down. Loan to value. This is also called, so debt to income is called DTI. Loan to value is called LTV. So basically the loan to value is the loan amount versus the price of your home. So if you bought a home at $300,000, you put 3% down as a homeowner, that means you have 3% equity and the loan is 97%. So the loan to value is 97%. So the lender is giving you 90%, 97% of the home value, and you're putting your own 3%. And that loan to value comes into a lot of play when rates are being determined, because this right here, your loan to value, I always look at it as how much skin do you have in the game. If you're putting 3%, a lender's going to look at you and go, okay, I'm giving you a lot more money and you're putting in very small amount. That risk is very high. And the lender, how they offset risk is through rate. So more risk, lower credit score, higher loan to value equals a higher rate. And that comes into play too when we're looking at rates. And then the last one was kind of going into the escrow account is PITI. You'll hear that a lot. It's basically your full loan payment. So it goes into your principal, which is the remaining balance of your loan, the interest, which is the cost of getting your loan, and then the escrow accounts, which we just talked about, the taxes and insurance. So all of that put together is your PITI, or your full mortgage payment. And then that gets calculated into your debt to income ratio. All right, so this is the most fun part, building equity. Because going through and buying a home may not be the most fun. It can be a little bit stressful. I try to mitigate it as much as possible. Royce knows that. But building equity is something to look forward to, because it is something that really gains kind of generational wealth and wealth that may not be gained without home purchase. And so it's pretty simple. Let's take a look at just an example. If I bought a $350,000 home, I put 3% down. I'm a first-time home buyer. I'm allowed to put 3% down. And the rate is 7.5%. So this slide was made a couple weeks ago, but rates they're going in between 7.5%. Sometimes on good days you might see 6s, but in reality we're in the 7s. So here, if we see this first kind of little column here, in 1 year, so this is a 1 year example, at 3% down and 7.5% as the interest rate, I have paid $3,129 towards my principal balance. So if my principal balance was, $330,000, now at the end of the year, my loan balance is like $327,000. I put $3,000 to my balance, and so I own more now because I put more to my loan, and I've increased my equity as my principal is being reduced. The second one we just talked about is appreciation. And I just looked at a 4.5. You can kind of see this little 4.5 right now. I'm just looking at a 4.5% appreciation on a $350,000 home. It's about $15,750. So when we add these two together, that's what we have in equity for the year. So a 1 year example of a $350,000 house is about 20 grand in equity. And that's from some of you paying off the loan balance and some of it going towards appreciation. And those are the two components of building equity. Now, the principal balance usually will always be reduced and start getting faster. The more time you're in the loan, the more principal balance is getting paid. Let's say you had a 30-year loan. In the first 10 years of your loan, almost 95%. And then it goes down each year, 95, 94, 93. But when you start, about 97 and 95% of your entire payment goes towards the interest, and a little bit goes to your principal. Now, as you go through that loan, it changes, and more principal gets paid off, and you've paid off less interest. And so that's how you can build equity. So after 10 years, you start building equity a little bit faster, since you're starting to pay off more principal from each payment. And that's how we build equity right there. All right, so how do we qualify for a mortgage? So we are looking at credit check here. So the biggest thing for qualifying, lenders are going to pull a credit report. And they're going to pull a credit report for a couple reasons. They're going to look at your credit score. That obviously is determining if you can fall into a different program and what kind of rate you're getting. They're going to look at your payment history. They're going to see if there are any late payments. Late payments are a big deal. Lenders don't really care about late payments for a credit, for like a credit card. What happens is if you have late payments from a credit card, your FICO, your credit score tends to go down. Lenders do really look at late payments for car loans though, because what lenders are saying is the biggest thing besides buying a home is a car. So if you're not paying that on time, will you pay for a mortgage on time? They kind of look at that, and they weight a car payment as being late as more heavy than a regular credit card. They're going to look at your debt levels. So what is a debt level? So, and we'll kind of go into this a little bit later, but a debt level just means like if I have, say, $1,000 in credit extended to me, let's say I have one credit card for $1,000. How much am I using that card is my debt level. If I'm at $800 and my credit line is $1,000, then that's 80% I'm at a debt level. Now, debt levels want to be below 30, and that really hangs heavy on your credit report. So they want to make sure it's called credit utilization. So the lender's looking at how you're utilizing your credit. And then they're looking at red flags. Like we talked about late payments, they're looking at collections. Now, some programs a little more lenient on collections, some programs a little bit more stringent on collections. So it's kind of like a case-by-case basis. And the majority of the thing is how many collections you have and what's the total amount of all those collections. Lenders don't like to see that above $2,000. So if you have more than $2,000 in collections, we want to try to start paying that off. And I can show you how we improve credit scores a little bit later. And then the last one is disputes. We'll talk about that in a second. But disputes can actually hurt your credit. And we'll look at that when we look at credit qualifying and how a credit score affects your mortgage. The second is income. And for income, we want to show stable income. So what is stable income? We want to make sure that you're at least in a line of, well, not in the same line of work, but you want to have at least a 2-year work history. Now, preferably in the same line of work, but if you're moving jobs to get better income, if you're in a job and you went to school or taken extra schooling and then start a more of a career focus, they look at that as favorable. But if you're bouncing all around in a retail or you're going there and there and there and there, they don't look at that as favorable, and they might ask for reasons why you're bouncing around, especially if they see your income staying the same, but you're constantly bouncing around jobs. They might ask questions. How do we calculate that? We usually need a couple of things. We need 2 years of your W-2s, and sometimes they ask for your tax returns. 1 month of pay stubs is pretty. So if you paid once a week, we need 4. If you get paid twice a month, 2. And if you're self-employed, we need your business taxes or your profit and loss. And then we can start calculating the income and the lender and talk about, your debt to income ratio. And the next is assets. So money for your down payment and closing costs. That's what DP and CC stand for. Couldn't fit it on the slide, so I abbreviated right here. So what the assets are looking for is we're looking to see if you have money for the down payment and if we have money for closing costs. Now, obviously in this market, we're getting a lot of seller credit, but a seller credit it's money from the seller that we could use to help pay for closing costs or buy down your rate. So we can kind of, help you with closing costs. And then down payment, we can use assistance if we need to. Even if we have assistance programs, the lender still wants to see your bank account. So we always ask for about 2 months of bank statements. Now, another thing too is 401k and retirement. A lot of times if you have a 401k or if you got IRAs or retirement, those are good to show strength in a file. So if you have, you've been paying in a 401k for 5 years and you got $20,000 or $30,000, you can always tap into that money. And the lender looks at that very favorably, because if you fell on hard times or you might have something where someone loses a job or something, you can tap into that and hopefully carry your mortgage until you get back on your feet. And then with any type of asset, any large deposit is going to be questioned. And this comes in, I see this a lot. A lot of people may not trust banks. I understand that with the Great Recession, that, is not too far in the past, but still, pretty present here. And they keep their cash at home. If you keep your cash at home, you can't just put that cash into a bank and use that cash for closing. It's got to be seasoned and sourced. So what that means is now sourcing could be cash, but seasoning is the most important thing. What that means is how long it's been in your bank account. So if you do, and you're thinking about buying a home, and let's say you do have, I just talked to someone, they had literally $10,000, $15,000 in cash in their home. So what we're doing is we're putting that in the bank. We're going to wait 60 days. And then after 2 months, we can use those bank statements and then be able to use that cash in the bank statement for closing. So for having cash, or if we have relatives that have cash for gifts, we want to be able to put it into the bank account and let it season for a couple months prior to utilizing that money for any type of down payment or closing costs. And then DTI, this is really important. So debt versus income. This is the biggest killer of loans here. The lender's going to compare your debt to your gross income. So let's go to your gross income for a second, because we never operate on gross income. When someone says you get paid $5,000 a month, you're not getting paid $5,000. We all know that, right? You might get only $4,000 or $3,900 a month, but the lender, they don't use your net income. They don't use your income after taxes. They use your income that the employer gives you prior to taxes or any type of 401k distribution or healthcare or anything like that. So That's good because they use higher income to help your debt to income ratio. But what we want to look at, especially when I'm talking to clients, is from a budgeting point of view. We want to know, is this payment good? It's not about your debt to income ratio because they look at a gross income. We want to look at, does this payment fit into what your budget has on your net income? And that's very important to note right there. When we look at your debt, it's only the debt showing up on your credit report. It's not like utility bills and your phone bills or anything like that. It's only debt on the credit report. And the ratios are, and we're going to go through this again. On the conventional side, your max DTI is 50%. You can't go above that. So what does that mean? That means the house payment plus all the debt on your credit report divided by your gross income cannot be more than 50%. FHA is a little more lenient. Their max DTI is 50. I put 57, but it's 56.99. So you've got a higher debt ratio of FHA. And that is that's really the big main reason people use FHA. A lot of people think it's credit score. It's not. It's actually debt to income ratio, which is the main reason why people use FHA. Now, VA, there's no max debt to income. You can go as high as you want, as long as, and we'll look at this, as long as you have residual income, which is income after you pay all your bills. They want to make sure you have enough money after that for your family. As long as you have that, your debt to income ratio could be 70, 80%. So if anyone has a VA out there or is a vet, that's really nice because they're not looking at a number or a percentage. They're looking at what your bills are and what we're looking, your taxes and your situation like that. After all that gets filtered down, do you have enough money set by the VA for a 2-family or 4-family or whatever they set for? And if you do, they don't really care how high your debt to income ratio is, which is really nice. And then USDA, the max DTI is 43. Sometimes it can go over 45%. We're going to go to USDA a little bit because it seems like a pretty good program because, again, USDA is very similar to VA. There's no down payment needed for both of those. And we'll go into that as we go into programs, but there's some stipulations on that, obviously. And then DPA. So DPA is down payment assistance. So if you guys are looking to use an assistance program, Home and Shipper one, Hometown Heroes is coming back, but they retro back. So it's not open to all Florida citizens anymore. It's only to heroes like police officers, nurses, stuff like that. So that can't be utilized by any type of Florida resident unless they're a frontline worker. But DPAs, and if you're using a county or a state program, they want to make sure you're not going to foreclose on the property. So what they do is they bring down your debt to income ratio. So they make it a little more tough to buy a home. Assistance are great because you're utilizing someone else's money and you may not need the money for a down payment. However, they have to fit really tightly into the shoebox they create because they're giving you money and they want to set the rules essentially. So they make it a little more tough and either bring down your purchasing price as a form, or, your income needs to be a little bit higher for the down payment assistance right there. All right. Types of mortgages. We are looking at conventional first. So conventional is like the mainstream one, right? It's usually associated with higher credit, and it's for first-time home buyers. It's really nice because you only have to put 3% on a down payment. Now, what constitutes a first-time home buyer is obviously if you haven't bought a home ever before, that obviously constitutes one. But if you bought a home, sold it, and it's been 3 years since your purchase of your old home, from the sale of your own home. So once you sold it, you have to wait 3 years. And then if you wanted to buy a home after that, you are considered a first-time home buyer. You only have to put 3% down. So that's great. Just 3% of $350,000 is only about $10,000 as a down payment. So it really makes it affordable. But credit score, I say 680, but really I would say 700 or 720 to really get a good credit score. Now, conventional looks at your credit score highly, and it looks at your down payment a little bit. But credit score really dictates the rate that is on conventional. And a lot of times at 680, which I still consider a decent credit score, conventional might get you a much higher rate than say FHA. So what we do is we kind of look at both and we say what works for best for us and how do we how does the payments kind of add up? And we can go from there. But you can get still good loans at 680 with conventional. But for the most part, if you're looking at conventional, I'd like to see your credit score in the 700s. DTI, like we just saw, is capped at 50%, and it's usually good for good credit and high income clients. So those are usually conventional. Now, FHA is a little bit more wider branched for more. I bought my first home using FHA because of student loans, to be honest with you. A lot of people go through FHA really because student loans or high debt, but I would say the biggest thing I always see right now is literally the elephant in the room, which is student loans. And so that increases your debt, and then that gives FHA a good pathway for you guys to work at. So the cool thing though about FHA is it's only about 0.5% higher than conventional on the down payment. So you're only putting 3.5% down. Credit score can go all the way down to 580. I want you to have about a 620 when we do FHA. And the reason is when you get below a 620, it gets really difficult, and the conditions and all of the stuff you have to do to acquire the mortgage becomes very, very tedious. Whereas if you're at 620 above, it's a much more pleasant experience is the best way to put it. So if you're at 580, usually I say, let's break down your credit report. Let's take a look at it and find the means to get you at a 620. And in most cases, we could do that in a month or 2 months to get you up to a 620. Now, FHA goes below 580. I've never done one below 580. There's 2 caveats with 580 if you're below 580. The first one is if you are at 579 on your FICO, you have to put 10% down on your home. You cannot use the 3.5%. It has to be 10%. And that usually gets rid a lot of people. I could never put 10% down on my first home. So that becomes very tough. And when you're below 580, the credit restrictions become very, very tight, and it makes it very hard to secure the loan. The debt to income ratio, like we just looked at, is 56.99. And this is great if you had high debt student loans. They're very, very lenient on collections. So even if you have a lot of collections, we can tend to meander through that and still get you the FHA loan. Cool thing about FHA loan, though, is if you had any charge-offs on your credit report, so a charge-off would be you didn't pay a bill, it went into collections, you never paid it, and then what happens is the original credit card or whoever gave you the money does it as a charge-off. It becomes a charge-off on your credit. You don't owe the money anymore. But in FHA, they don't really care if it's been charged off. They don't look at any type of that. You don't have to repay that back or anything. So that kind of works out as far as, being able to have, some little blemishes on your credit report and still be able to use FHA. And just like I said, there's some restrictions as we get lower in the credit score and a little bit higher on the debt to income ratio. So VA, if we have any vets out there, this is an amazing program. I mean, the VA program is just amazing, because you have 0 down payment. I just closed on a VA loan last Monday, a week ago today, and it was a $595,000 house. And they had to bring in $4,000 for the entire thing. They didn't have to put a down payment on it. We got a seller credit to cover most of the closing costs. So their entire amount of money they needed for almost a $600,000 home is only $4,000. And that is very, very affordable. VA is a great program for that. Minimum credit score is a 580. They don't have the same restrictions of FHA putting down payment. In fact, you could go below that if you had overriding factors. You make good money, but you have some blemishes on your credit. You have low debt to income ratio. I've seen VA being approved at 550, 540. It gets a little hard under 520, but I've seen 550 and 540. There's no max on debt to income ratio, but like I said, you must pass the income test. If any one of you is a vet, you can easily look up, it's called the residual income, and you can see where you are and how much residual income is for how big your family is. And as long as you have that much money after everything's kind of settled out in your day-to-day life, they don't care what your debt to income ratio is. And like I said, this is only for veterans. It'd be great if it's for other people, but we deserve this for our vets. Our vets put their lives on the line for everyone. So it's a great way to become a homeowner as a vet. The one thing about VA too is if you guys are in the Coast Guard or the National Guard, there is a longer waiting period than if you were in the Army, Navy, Air Force, Marines. I think it's a 6-year waiting period or 4-year waiting period if you're in the reserves or National Guard or the Coast Guard. So just to kind of let you know, if you're in that, you might have to wait a little longer than a normal Army or Navy type of vet. And then USDA. So USDA is great because it has a 0% down payment. But like it's U.S. Department of Agriculture. So it's mainly for rural areas. But in Florida, almost every county is approved for USDA. It's almost every county. There's very small in Southeast Florida, obviously, would be one that it's not USDA approved. But for 98% or 97% of Florida, it's mostly USDA approved. So that's great. You don't have to put a down payment on it. It's very similar to VA where you just put no down payment. So you're just paying the closing cost. And then the credit score is about a 640. So that's their minimum credit is a 640. The biggest thing that I always find with USDA, because everyone says, this is great. I can find a property. It's in my area. I don't have to put money down. But one of the problems with USDA is their debt to income ratio. Anything above 43, you have to have very high credit, way above 640, and decent credit history. And it may go up to 44 or 45%. The problem is at 43%, it gets really hard to approve somebody like that. Even people with great income, their DTI may not be, it may be in the high 40s or low 30s. So having your debt to income ratio in the low 40s sometimes is usually hard to attain when you're not putting any down payment on there and rates are so high right now. So I'm finding a lot of interest in USDA, but as we kind of fill out the application, we pull their income and all that stuff, it becomes more apparent right now that in a higher interest rate environment, it's very hard to approve people for USDA. All right, so credit scores. So this matters, right? So high scores, we consider 680 and above. You receive lower interest rates. You obviously have lower down payment, especially for FHA. You only have to use 3.5%. With a high credit score, many payment assistance is available. You won't have to worry about it. If you have a 680 FICO, you have access to any type of payment assistance as long as you fit into their guidelines. Much easier underwriting. If your credit report is not so heavily flagged and so many blemishes, it's a much easier way to underwrite. And so you see really a much less stressful transaction. And in that, it's a lot less conditions to close. So tends to be a little bit more streamlined way of doing business right here. Below 679 and below, we get higher rates. You may only be able to go FHA. At a 679 below, I would always say definitely go FHA. FHA has better rates for lower credit scores. Have a higher down payment. Obviously 3.5% for FHA. And if you have below a 580, you have to do 10% for FHA. Payment assistance is limited. So most payment assistance, their minimum FICO score is about a 620. Most of them want to see you kind of like what USDA wants to see you in the 640s. So if you do need assistance and we pull a credit report and it's lower than that, we need to find ways to kind of boost your credit. And like I said, if you have more credit problems, you're going to have more conditions. We just have a lot of explaining to do is essentially what we have to do. When we think about a lender, they're giving you hundreds of thousands of dollars. We're not buying a car, we're buying a property, and they're literally lending you hundreds of thousands of dollars, and they want to make sure they're going to get their money back. So a lower FICO, a lower credit score represents more risk to the lender. More risk equals higher rate and more scrutiny on the file. So how do we improve credit scores? This is different for everyone, but here are just a few examples of how you can do this. If you have, let's say if you have a 620 right now, paying bills on time, getting rid of late payments, just to let you know, let's say you had a late in June, your credit score takes a hit. It's about 12 months of not making any late payments that hit removes from your credit score, and you'll see your credit score increase. So late payments definitely stay on your credit. And the other thing about late payments is they always show on your credit. It doesn't matter how long it's been, the lender will see you've made late payments, and it can go back years. So it may not affect your credit score, but lenders can see your late payments and may ask questions in regards to that. And like we said in the first one, credit card utilization. So I always tell people, if you had a credit card for $1,000, I don't want to see you put more than $300 at any given time. And I want you to pay that off about 5 days prior to your due date. So I had a lot of people use their credit card and then 3 days later pay it off. Use their credit card, 2 days later pay it off. That absolutely does nothing to raise your credit score, because what the credit companies want to see is you utilizing some credit. And if you're using your card and then paying it off 2 days later, the credit card company doesn't have enough time to report your utilization to the credit companies. And so you'll always show a zero balance, and the credit companies say, okay, well, they got this credit extended to them, but they're not utilizing it. And so that actually brings down your credit score. Don't close accounts. This is really big. If you've paid off a credit card, put it in a drawer, save it. You could cut it up if you wanted to. Just don't close that account. The more you have credit extended to you, the higher your score is, and the less about credit utilization comes into play. So if I just paid off a credit card with $2,000, most people want to cancel it and get rid of it. That actually brings down your credit score. Whereas if I had it paid off and then I'm paying off another card and I'm bringing my utilization down, that actually increases my credit score. So don't close accounts. I would cut up a card, put it away, lock it up, whatever you have to do so you don't use the card, but don't close the account. Okay, this is a big one. Don't dispute accounts. So a lot of people think that disputing account actually helps you out. It is actually kind of, for lack of a better word, it's kind of screwing you over. And what happens here is when you're disputing account, let's say something came up and it went into collections and you disagree with them, and you call them up and say, I want to dispute this. Okay, they're gonna put client disputes account on the credit report. And what happens is when you have a disputed account, that trade line, that credit card, that installment, you can't dispute student loans, but any other type of dispute, that doesn't get factored into your credit score. That's very important to know. A disputed account, when I pull your credit report, does not get factored in to the credit score. So what does that mean? That means that when I pull a credit report and I see a disputed account, and let's say your credit score is at a 620, I have to ask you to call the bureaus, to call the credit companies and have them remove that dispute. Now, when I remove that dispute, I now have to go pull a new credit report, and then it's going to take in that collection, that dispute. And 9 times out of 10, what happens is your credit score goes from 620 to 590. And so even though disputing accounts might be, hey, I'll dispute it, it doesn't work to your advantage in any means possible to buy a home. Mortgage companies cannot close on a loan with any disputed accounts on a credit report. So disputes hurt you when you're trying to buy a home. That's the only time it hurts you. If you dispute an account, you go buy a car, they don't really care. When you dispute accounts and you go buy a home, they cannot use that credit report. They cannot use any credit reports with a dispute on it. And that usually hurts people. So my whole thing is try and settle with collections. And I always go on a case-by-case basis. I have scripting that you can call the collection on and really go through and hammer them to remove the account once paid in full, to settle for a lower amount, and then remove the account. There's different ways we can work with collectors because they want that money and they paid pennies on the dollar for that account. So if you have $2,000 in collections, they probably bought that for maybe $800. So we can settle with collectors, and they may not always, but sometimes they can remove that account and completely remove it from your credit report. And that really helps. So whenever you have, collections and you're looking at buying a home 2 or 3 or 6 months down the road, first thing is, let's come to look at me. We can do a look at your credit report. We can look at the ones that are in collection, and we can set up a pathway to pay them off, call them up, do whatever we need to kind of help you with that. because credit score really matters when it comes to buying a home. All right, so let's look at the biggest thing I always talk about to my first-time home buyers, rate versus price. Now we're going to get into some interest rates, and then we're going to look at really quickly the strategy I use to help all of my first-time home buyers and secondary home buyers in this market. So the biggest thing is rate versus price. So let's just talk about this. We buy a property at $400,000 at 7.25%, payments say $2,592. Okay, this would just be the principal and interest payment. This is not taxes and insurance, just to let you know. I just wanted to look at the mortgage payment. Okay, and most people, when they're going to go buy a home, they think, well, if the home is listed at $400,000 and we're in a environment where, you know, it's harder to buy a home because rates are so high and there's not many buyers out there, I want to go in and offer less money for that home. And let's say you go in and you offer $388,000 for this home. So 3% less, $12,000 less on the home. And the interest rate's the same. We're not doing anything with rate. We're just saying, hey, seller, I want money off of the home price. What this does is it saves you about $77 a month. In a mortgage that's $388,000 or the loan amount's $368,000, saving $77 a month, not really that much savings, right? It's just not. So this is where rate is the elephant in the room right now. Because if we just took that same 3%, let's say instead of reducing the purchase price by $12,000, we asked the seller, I want 3% as a seller credit, which is cash. You think about a seller credit, you think about you get that cash at closing to buy down your rate or to pay for your closing costs. In this instance, we're using the cash from the seller to buy down the rate. And when we do that, we're going to go back up to $400,000. So we're going to go back up to the original price. We're going to ask for that 3% as a seller credit, but we're able to buy the rate down to 5.875 at that level. This is massive because look at this. The same property, instead of $2,592, the payment's $2,247. You're saving $344 a month just by reducing the interest rate. Now, let me just tell you, every rate buy down I do is permanent. This does not change. There's a lot of things out there with temporary buy downs. I always do permanent buy downs because I want you to have a good rate forever, because I don't know when rates are going to come down, and people that do temporary buy downs, they're temporary. And all these people that did temporary buy downs 1, 2, 3 years ago, they're going back up to a rate that's in the 7s, and they can't refi right now because the rates are still in the 7s. So I always want to do a permanent buy down. So let's just look at the best strategy for this market. And I call it the no refi. And then how do we increase your purchasing power? That's very important. So we're going to look at these real quick. So this is basically from the last slide. You're looking at $400,000. Let's just say you're pre-approved at $400,000, right? And you're like, Jeff, I can't find a home for $400,000, right? I just can't. And so what we'll do here is I need an extra bedroom. I need a bathroom. I need another, 2-car or 3-car garage. I'm just not seeing at this price. So how we do this is we take that buy down, the rate buy down. So these two are the same slides from the other one. And you see $344. We save $344,000 or $344 right here, buying down the rate. But what if you said to me, Jeff, I'm okay paying $2,592. I just can't find any homes at $400,000. So this is what we do to help increase your purchasing power. If we can buy down the rate to 5.875, I can keep this payment at $2,592. Then I can increase your purchasing power to $463,000. So now what you look at is a purchase price of $463,000. Rate, this is a permanent rate buy down, like I said, at 5.875. See the payment, $2,592, $2,592. They're the same. The only thing that's changed is rate. So now what we can do here is I can give you a home and give you a pre-approval for a home at $463,000, but at the same payment as a home worth $400,000 in this market. Very important. Increasing your purchasing power in this market really, really helps you motivate to buy homes right now, because as rates come down, the tendency for a seller to give you any credit or reduction in a home price gets lower and lower. But the other thing about this too is if we have a permanent rate at 5.875, You don't have to refi in the future. This is super important. Refinancing in Florida is very expensive. It's the same cost as a purchase, except you don't have to put a down payment on it. So Florida refi is very expensive. You have to pay doc stamps, intangibles, title, all that has to be repaid. But if we can save you money and basically say, look, at like if rates drop to 5.375, I'm only saving $100, $138 a month, so I'm not going to spend $14,000 on a refi to save $140 a month. That doesn't make any sense. Why would I spend? No investment's good. Your investment at this point in time would be the cost of the refi to save you some money via a lower rate, right? And so right now we want to say, okay, I'm saving $140, but it's costing me $14,000, $15,000 to do it. That doesn't make a lot of sense, right? So when we are able in this market right now, I do this to all my clients, when we're able to lock a loan in the fives, when or even if rates come down into the fives, you've just saved yourself your entire refinance. You don't have to refinance. All you have to do is kick back and watch your appreciation grow, because you don't have to refi. Rates are coming down. People are entering the market. Your home value is increasing as a result of that. And you're just sitting there back going, I've got a great rate. I don't need to do anything. So that's the biggest strategy I'm deploying out to everyone right now, simply because obviously rates are high. We're in the sevens. How do we handle that? Sellers are feeling the pinch right now simply because they need to sell their home and no one's buying it. Their buyers are just not there. So if you are looking to buy a home right now, it's a great time to buy, because we can negotiate with sellers. We can reduce your interest rate. We can create affordability, and we can almost help you with closing costs as a result of that. So that's it. I just want to say thank you, everybody, for attending, and I appreciate the people. I think you're on mute, Royce.
Sorry, that was a lot of great information. I was taking notes, and we do have a couple questions, and I'm going to try and go in the order that they were asked. But the first question was regarding the hometown heroes. Do you have any idea on why they stopped with the hometown heroes? Like why they changed it from Florida, from everybody?
Absolutely. Last year they opened up to everybody, and the funds lasted like 6 weeks. Mm-hmm. That's it. And then everyone got pushed out, and then people were already planning to do it. And once the program got engaged, everyone already had their stuff, and the funds were just gone. I think it started last year. It started the day after 4th of July. And I think it went to maybe August 16th is when they ran out of funds or something like that. So it was like 6 weeks. So they made it a little bit more strict to kind of go back to the original plan to maybe make the funds last a little longer for any type of first line responder.
Which makes sense. It does, because I know people were already planning and to find their houses or had their houses already lined up in order to be able to take advantage of the program.
And just to let you know, Hometown Heroes is not the greatest program, because your interest rate is automatically in the high sixes. And when they give you that money, say 30, 35,000, I think was the cap, you have to pay that back. That is not a grant, right? And so you can't refinance until you pay that back. And or in your home long enough where I think there's a step downs after so many years. So you might have to be in the loan for 5 years in order for you to do a refinance. And if you're at 6.875 and let's say 2 years, rates go down to 5.5, unless you have the money to pay that off, you can't refi.
Makes sense. And I'm glad that you brought that up, because honestly, whenever I have a consultation with a new home buyer, I always ask this question, because this is the market that we're in and we have been in a while. And the most important question I ask everyone when they're thinking about financing is what's more important to you? Is it the monthly payment or is it the out-of-pocket expenses? Because to your point, when you're talking about these programs, these down payment assistance programs, their interest rates are usually higher, which means that your monthly payment is going to be higher. And so, so you kind of have to say, hey, do I want to save money out of pocket, or do I want to have a lower monthly payment? And that will help you kind of determine which program works best for you.
for down payment assistance, it's a vicious cycle because
Mhm.
you're using someone else's money, which increases risk. When you increase risk, you have to increase interest rate. When you increase interest rate, you're increasing payment, but down payment assistance has a lower debt to income ratio. So it's
Mhm.
very difficult to navigate. You really, down payment assistance it's not for low income earners. It's just not, because in Florida, if you have a down payment, if you have a DTI, say, and your cap is at 45% and your income with the interest rate at 7%, some of these down payment assistance are 7.5%. The property you're approved for is $175,000 or 100. You can't find homes like that anymore. And if you can, they probably won't pass an appraisal inspection or home inspection,
Yeah. Yeah.
and so it's such a vicious cycle with these down payment assistance. I see it a ton. They want the down payment assistance, and then afterwards, to be honest with you, I haven't done a down payment assistance since so long, because once they realize that they can't buy the home they want, or the interest rate's so high, then one of two things happens. They dip into their 401k just to utilize it, or they find family or something like that to give a gift and go that way.
Gotcha.
It's just a much smarter way. It's just really
Yeah.
such a smarter way.
Yeah. And I agree, definitely.
I'll
So
just
going
real
back.
quick though, I will tell you, like, if you guys have 401ks, it's very good to use that as a down payment on a home. Okay, it
Mhm.
really is, because one, the payment that you have to repay that back, that does not get calculated in a debt to income ratio, so it doesn't get hit on your DTI, and you're taking that money and you're sheltering it a little bit,
Yeah.
and
Yeah.
so if you're taking 20K and you're putting it into something that's worth 400K, at a 4% or 5%, or even when we get higher at 6% yield, you're kind of helping offset the current interest rate, and you're helping offset any type of loss you might have, in your portfolio.
Makes sense. Makes sense. And that's what I did when I bought my first house. I
Yeah,
dipped into my 401k and I purchased my home.
that's a
And it
great way.
wasn't anything too hard to do either. And so I
No,
don't regret
super
it at
simple.
all.
Yeah,
Yeah.
very simple. You'll have the money in your account in like 4 days. That's how fast it
Yeah.
is.
Real
Yeah,
quick.
yeah.
Going back to when you were talking about disputed accounts, we had a question because you had mentioned that the disputed accounts, and I took some notes, the disputed accounts don't get factored into your credit report. So, what if the dispute is closed? You still have to go back and try and get that re-factored into
No.
your. So once it's
If it
closed,
says
you're good to
dispute
go.
resolved by a grantor or client or something, or dispute closed, no, that is already removed. Sometimes they put that on there, sometimes they don't put anything on there. But if
Okay,
it doesn't say anything, then the lender doesn't know there's even was a dispute. But
got
if
you.
it says in dispute or client disputes account, that's the only time it gets factored into your credit, or it doesn't get factored into your credit score, I should say.
Got it. Got it. And then how is it determined how low the rate can be brought down? And is there some type of formula to deter like how
It's
much it'll
all
cost?
market. Right now we were getting rates lower, and then Friday or Thursday came out and the jobs number came out, and that's inflationary, and rates went back up, and so it really determines. So the one thing that determines it is how much seller credit we can get from the seller. And
Okay.
that's one of the reasons why I really love FHA, because in conventional, if you're putting less than 10% down, you can only get a 3% seller credit. That's it.
Mhm.
FHA, you could put 3.5% down and you could get up to 6% as a seller credit. And right now in this market, I'm seeing 4, 5, 6% in seller credit. So
Yeah.
we're buying the rate down low enough where I told them, like, you don't even have to refi into a conventional loan for a very long time.
Mhm.
And one of the things I knew for time, we didn't get into mortgage insurance because that could be almost its own type of like course. But FHA has mortgage insurance, and it doesn't leave. It doesn't go away.
Yeah.
Conventional has mortgage insurance for a limited time. It depends on the loan to value, and then in conventional, it gets removed. You don't have to refinance. It just gets removed. FHA, you have to refinance into conventional to remove it. But if we had a rate at like 5.125, which I've been locking stuff like that right now for FHA, I'm telling my client, it doesn't even matter, because the
Yeah.
amount of savings you're seeing off 5.125 versus a normal conventional loan at like 6.5 or something, you're saving so much money. It doesn't care how much your mortgage insurance is.
Gotcha.
For 5 or 7 years, you'd stay in this loan until until you're ready to leave. So that's why I really love FHA. I'm closing a lot of FHA I've had a lot of people at 700, 720 use FHA because we can buy the rate down where they don't have to refi for a while, and the savings is less than conventional.
Yeah, it makes sense. And then I think too, at that point, a lot of times FHA with those credit scores is usually a lower interest rate anyway, right? Than even if you had the same rate at conventional.
FHA starts about 1/4 to 1/2% lower than conventional.
Yeah.
And the reason why that, guys, it's a government-backed loan. So it's backed by the faith of the government. So it offsets risk. Anytime you have an offset of a risk, higher credit score, good income, low DTI, putting a lot of down payment on there, you always get a lower credit score.
Makes sense. Makes sense.
Sorry, a lower interest rate.
Got you. Well, I think that was all the questions I had. I'm going through the different platforms just to make sure that I'm not missing anything. But before we head out, and I wanted to get Jeff. I don't know did you have a slide that has your contact information where people can reach you?
Oh, you know what? I think I do. Let's see here.
And while he's looking for that information so that you guys can contact him, I want to remind you that we have our next class as part of our homeownership and financial literacy educational series. We will be covering homeowners insurance. So this class is for anyone who's thinking about owning a home, currently owns a home. These are Tanya Johnson will be coming on to discuss the ins and outs of homeowners insurance. Those of you who are in Florida, we know how, and especially if you're a homeowner in Florida, we know how much homeowners insurance has gone up. And so she's going to give us some key tips to how to navigate homeowners insurance as a potential buyer and as a current homeowner. Okay.
And I don't have that. I don't know what happened. I must have deleted that. I think I deleted 2 slides too. And obviously it was that one. So, but if you have any, just reach out to Royce. She's got all my contact information for sure.
And I will actually post it and add it to the YouTube page and the Facebook live replays. And so if you have registered on the Zoom training, you will also get a copy of this replay with Jeff's information so that you can feel free to contact him. He will do a personal consultation with you if you want to go ahead and get pre-approved, no matter where you are. Well, Jeff, let me not say that. Jeff services what states?
Florida. Just Florida right now.
Just Florida for right now. So if you're in the Florida area and you're looking to get pre-approved, no matter Miami, Tampa, Destin, wherever, Jeff can help you. And he's amazing. I can vouch for him. He's my go-to. I send him basically all of my clients who are looking to get pre-approved. He is your guy. As you can see, he knows a lot, and it's a lot he didn't even share today. So I want to thank everyone for coming today. Thank you, Jeff, for educating us. There's a lot of things I didn't know about the disputes. I knew about not having disputes, but I didn't know that it would exclude that credit line from being on your credit. So that is really, really good information. I'm always learning when I come to these trainings as well. And so I hope everyone found value, and I look forward to seeing you on Wednesday. Thank you again.
Take care.
Have a good day.